in thinking about how capital markets work, the really key fact is to think about the big trade-offs that occur across time. When you're buying and selling goods, it's happening at a point in time. Labor is sort of a point in time. But when you borrow money, when you receive financial capital, you're essentially buying the use of the funds now and paying for it with interest payments or a rate of return. For example, this is what you do with a college loan. You get the money now, you repay it in the future. House loan, you get the money now, you repay it in the future. A firm that borrows to build a new factory, get the money now, repay it in the future. On the other side, when you save, you're agreeing to give someone your money now. And in return, you're going to get an interest payment or a rate of return. So you're handing off the money on the condition that you receive something in the future. Now, getting a certain dollar amount of money now is better than getting that same amount a few years in the future. If you doubt that's true, just think about this situation. Someone owes you $100 or something like that, and they say, well, I've got your $100, but I'll pay you 5 years from now. You wouldn't feel like that was the same amount of money. Having a certain level of dollar expenses now is also worse than having that same level of dollar expenses in the future. If you can pay later, you'd rather pay later. This is true even if there's no risk. It's true even if there's no inflation. There's a clear implication here. Money in the present is worth more than money in the future. If you want money now instead of in the future, you have to pay for it because the money is worth more now than it would be in the future. Now, I've given some of the reasons this is generally true. In the future, the money could be eaten away by inflation. In the future, there's a risk of not being paid. In the future, somebody had to defer consumption. There was that time value of money. But the bottom line is $100 right now in your hand is worth more than $100 a year from now or several years from now. But how much more is it worth? How do you compare worth in the present to worth in the future? And the concept economists have to use that is the idea of present discounted value. Present discounted value is a way of taking costs or benefits that occur at different points in time and comparing them directly. Present discounted value is the amount that a future payment is worth in the present if it was to be received immediately. Now, let's think about in practical terms what that means. What is $100 a year from now worth in the present? Well, let's assume, for the sake of the argument, that the interest rate is 10%. So you pull out your handy-dandy calculator, and if you were given $90.91 right now, and you invested it for a year at a 10% interest rate, then you would have $100 a year from now. So, the present value of $100 a year from now, if the prevailing interest rate is 10%, would be $90.91. What's $100 worth 2 years from now, if you think about the present? Well, if the interest rate is 10%, you pull out your handy-dandy calculator, you can figure out that if you were given $82.64 right now, and you invested it for 2 years, and you got a 10% return each year, it would equal $100 at the end of 2 years. So, the present value of $100 2 years off in the future, if the interest rate is 10%, would be $82.64 in the present. You can kind of see how this formula is working for taking a future value, money received in the future, and changing it into a present value for what it's worth right now. If you want the explicit formula, the present discounted value is going to be equal to the future value divided by 1 plus the interest rate raised to the power t of the number of years. But you can just sort of think about it in terms of what is the future expense worth in the present? How much money would it take in the present if you got it right now and you invested it at the prevailing interest rate for the appropriate amount of time? How much would you need to take in the present to equal whatever the amount is off in the future? Now, this concept of present discounted value actually has a lot of very practical applications. It's one of the most heavily used tools in business finance. In business investment decisions, for example, businesses have to think about investment expenses that they incur right now when they build new plant and equipment, and returns they would get off in the future after they can produce stuff with that equipment. So for example, let's say that a firm wants to build a factory that costs $2 million, and it calculates that 5 years from now, it will earn $3 million. Well, that firm had $2 million in the present and revenues of $3 million, which are 5 years off in the future. Has it earned $1 million in profits? Well, not in any true economic sense, because those $3 million 5 years off in the future would need to be discounted back to the present, so you could compare it directly with the $2 million you have to spend right in the present. You need to take into account, if you think of it a different way, the opportunity cost. If you'd invested that $2 million for 5 years at the prevailing rate of interest, not bought plant and equipment with it, you would have earned a return over that time. It's only the amount above and over what you would have gotten from the prevailing interest rate that's really profit to you and your firm. If you have a home mortgage, present discounted value is very relevant to you. You probably remember what it looked like. If at some point you had a 30-year mortgage and you looked at your total payments, there's just some huge amount of interest you're paying over time. But here's an interesting thought. The total value of all of your loan payments, including interest, is exactly equal to the present discounted value of your house, which is the purchase price. After all, you could either pay cash for your house, that's paying the purchase price right now in the present, or you could borrow money and pay over time all the interest. But those two things are equal payments. They have the same economic value. It's just a question of, for most people, it works a lot better in my financial life if I pay off my house slowly than if I try to pay for it all at once. I can't pay for it all at once. But the present discounted value is the same in both cases. When it comes to social policy, there are lots of government programs that involve buying something now or building something now and then having a later payoff. A lot of environmental issues have a cost now and a benefit in the future. Traffic safety might involve building a highway in a certain way now for saving lives in the future. Or there might be expenses for helping children now, which will pay off in the future. All of those need to be analyzed using this idea of present discounted value and comparing costs in the present to benefits off in the future. Here's one odd application of present discounted value. When most state lotteries announce their big jackpots, they add up all the payments you would receive over 30 years. They don't tell you the present value of it, they tell you what you would get over 30 years. In New Jersey a few years ago, they wanted to pass a law that if an older person won the lottery, they could get their prize all at once. They shouldn't have to wait 30 years. After all, if you win the lottery and you're 70, you might not be alive for another 30 years. But the lottery had to explain that the prize they announce over 30 years is not the present discounted value. The actual value of what they've got is only about 2/3 of the announced total. Now, of course, that doesn't mean it's not chopped liver to win the lottery. It's still a great thing to win the lottery, but it's not quite as good as advertised either. The lotteries like to play games with present discounted value and make it look like the prize is somewhat bigger than it actually is. Now what I want to do is shift the focus a little bit. Now that we've got this idea of present discounted value in mind, this idea of supply and demand in financial capital